Hey, what's going on, Sam?
Hey Spencer, how are you?
Good. How are you doing?
Not too bad.
We've actually looked at a number of third-party underwriting softwares or just platforms in general that we think could make our company more efficient. And these companies become obsolete in 2 to 5 months, and others shift their focus entirely. So, like, how do you stay on top of kind of this ever-changing landscape, especially when technology is changing so rapidly? Do you have any internal playbook that you're following, or is it really just see what other people are doing?
So the problem with an internal playbook is the minute I write it, it's out of date.
Yeah.
And so what I told everyone is we are a dinosaur of an industry. Real estate is about as old school as it gets. Okay, it's sticks and bricks attached to the ground, and it's a financial conduit to get money out of whatever your resident's hand or tenant's hand is into the hand of your investor. And all the points in between are constantly morphing. And everyone wants to come up with the solution for yesterday's problem, which is today's hot button, topic: fraud, revenue management, business intelligence, you name it. But at the end of the day, it really comes down to access to information to make the best possible decision, to be able to keep my staff up to date, my residents happy, my turnover low, and the cash flow coming. So when I've got 5 different groups that are coming at me with a revenue management solution because of all the headlines that RealPage is going through, I'm
Mhm.
like, yeah, but RealPage is still the premier revenue management software for a reason. So it's hard for you to want to take a flyer on something else that's already kind of an inferior product. Now, the data transparency piece behind revenue management, there's a lot of groups like that have said, hey, we want to be able to provide a transparent solution to that. That's great. If I have one complaint right now from a prop tech standpoint that feels like a dinosaur, it's the software groups that have been bought by private equity that refuse to evolve. There's a reason Collectech is in place. The guy that invented like a platform to collect debts and deal with your delinquency built his company up, sold it to Assurant. Assurant started running with it, but Assurant's not that great at innovation. After his 3-year dark period where he wasn't allowed to compete, he spent that entire time perfecting his platform, and now he's got Collectech. So why would I hire Assurant, even though they're kind of a one-stop shop, when I know that all of those stops are 2018 technology and not doing well? I use a lot of RealPage's suites. 5 years ago, I hated RealPage. I was forced to use them because it really was the best revenue management software, and I saw them buying up everybody in sight and trying to integrate, and it was struggling. And Dana and her team came on board after the private equity group that bought RealPage said, "Hey, we need a more innovative approach," and they started listening to their customer. What a novel idea.
Shocking how
Yardi doesn't listen.
you can
Yeah,
change when that happens.
Yardi doesn't listen to their customer, and Entrada listens too much. And so you just have to figure out, okay, if I'm a dinosaur and I work in, years and months, and prop tech works in nanoseconds, how do I figure out a way to take advantage of the newest and greatest software solution, but not be beholden to that integration piece that could gum up the works. It's like, wow, you did solve this problem. However, you're about 6 months too early. You need to vet it out. You need to be able to afford the insurance for cybersecurity. You need to understand that you can't just integrate with Yardi and call it good. You need to be able to integrate with multiple platforms. And the other one is, uh, if I'm telling my resident I'm going to give them 6 apps to live in my apartment complex, that's 5 too many, maybe 4 truly too many for them to understand everything. So don't talk to me about fraud protection. Oh, and then I'm going to verify your income. Oh, and then I'm going to verify your credit. And then I'm going to do a criminal background check. Can't you do that all at once?
Hmm.
I'm sitting on the advisory board for Umbrella. They're really good at that fraud piece, and they're adding the other elements, but it's a little bit slow. And by the time they get everything fully integrated, somebody else is going to do it better. or RealPage is going to figure it out and say, hey, we've been doing this all along. Why don't we just turn it on? And, you know, the thing that I always come back to, especially having spent so much time in Seattle, Zoom became the flavor of the week thanks to COVID.
Mm-hmm.
And before that, you had Skype. And I think it's this month that Skype goes away. But the thing with Teams was Microsoft didn't need to monetize Teams the way Zoom did in order to be successful. They gave it away. So if you're Yardi or your RealPage, or even your Ferrantrata, because they've been on kind of a buying streak lately, they provide something for free that I have to pay $1 a unit for someone else. That puts that guy at $1 a unit out of business pretty quickly.
Mm-hmm.
And so I think the playbook is stay active, stay involved, and don't be myopic in your thinking. Get out into the conferences, get to know the vendors, see who's in the space and who's being truly innovative, and help further that conversation so that they learn how to integrate better with the management companies. On the management company side, as an owner, it's about telling them, okay, I'm willing to be a beta tester for this group or that group because I want to see how it works on my properties. I think I have some faith in their product or their team, and I don't want my management partner to be a roadblock to innovation, but I don't want to innovate just for innovation's sake. And then the final piece of that is don't be set in your ways. The example I use when I talk to management companies, when I talk to asset managers, when I hire people, and granted, now I'm starting to become a dinosaur. 20 years ago, I have an apartment complex. My God, if I didn't have the cover of For Rent magazine, I'm never leasing a unit or driving traffic to the site. And 10 years later, For Rent magazine doesn't exist.
Mm-hmm.
And all of a sudden, you have to learn how to deal with geofencing and SEO campaigns. And, my God, if you don't have the apartments.com platinum diamond package and you're the top of a Google search, then you're never going to rent your apartment. Oh, shit,
Mm-hmm.
I don't need CoStar anymore. I think CoStar is outdated. And the apartments.com platform is an interesting marketplace, but I can spend more money on my website and spend the money with Google and probably drive more qualified traffic to my site through those channels. And eventually it's going to become even more difficult to make something like that work. So I think that you just have to be nimble and not allow people to say, well, that's the way we've always done it. Long-winded answer to why I don't have a playbook, but it kind of shows you the way I think through being an asset manager and an owner using third-party management and having both a preference to having my management company coming to me with solutions, but still willing to listen to a vendor directly when I think it truly adds value from a risk management standpoint.
And I feel like that's the approach you kind of have to take, right? You have to be a little skeptical in all new technology coming your way and all of the snake oil that's being peddled your way. But at the same time, you also need to be open-minded, because if you're set in your dinosaur ways, and you're marketing on, what did you say? I don't even know that publication that you mentioned, like Rent JLG.
For Rent magazine became Rent.com, became Rent. And Rent. Was just sold. They were bought by Redfin. They were sold to Zillow, or there was an integration because they couldn't get through the SEC. And then all of a sudden you see Redfin's now being bought. So it was a situation where multiple groups that were public or privately held were being shuffled around. And a lot of the best talent at Rent. Now works for Zillow. So it's just a matter of kind of keeping an eye on who's doing what where.
Where are you keeping your eye most closely to right now, just in the industry in general, on a macro level, as it relates to trends you're seeing on the development side of things?
I think I've had more conversations about the impact of tariffs than anything in the last few weeks. And it's interesting. I tell our board of directors all the time, 1 month does not make a trend. When I look at what's going on when it comes to supply chain now because of the tariff situation, and how sensitive capital is to the daily now movements of the 5 and 10-year treasury, are probably the two things that impact my ability to do my job even though both of those are technically macro trends, they're now becoming micro trends because of how we're living in the media by the soundbite of, hey, treasuries went up today. Oh shit, transactions stopped. Oh, they went down. Does that mean that it opens up? No. Are cap rates tracking it? No. Cap rates have no correlation to the treasury right now whatsoever. It's too volatile. And then, everybody knows that the current administration uses the media and the threat of tariffs or sanctions far more than actually implementing them. But it's moving markets right now. You've seen, in essence, both the NASDAQ and the S&P in correction territory based on headlines where not a single tariff has really truly impacted anyone yet. And so I think that from a macro level, those two things are probably moving the needle more than anything.
And how are you kind of battling those headwinds right now internally?
So when we went out to bid for our GMP on a development deal in Savannah, Georgia recently, and we're going to have that ready to sign by the end of this week. At the same time, we're raising, debt, pref, and common equity for the deal. Those JVs are in the works, and we're going to close on all this by the end of the month and start breaking ground in April. As we did the bidding, and as we're working through the buyout piece of the general contract, it's about understanding where the commodities come from and where the finished product comes from. I know a lot of appliances, a lot of our HVAC are made in Mexico. That's going to be a big deal. I know a lot of our switch gear and a lot of the raw materials are sent to China and come back in the form of light switches and faucets and light fixtures. So understanding, can we buy some of these things domestically if we need to, or are we going to be beholden to these ups and downs of the supply chain and the cost? So getting ahead of that and buying out early and working with our partners, because debt and equity don't like to do a lot of prepayment of materials, they have to get comfortable with it. We were able to do it coming out of COVID when we were dealing with massive inflationary pressures and supply chain issues. I don't think it's a matter of getting the material now. It's understanding where the point of origin is and how can we stockpile to kind of hedge our bets against what's going on again on a daily basis when it's usually more of a quarterly or an annual basis. And if there's an alternative to buy or build domestically, what's the premium for that?
Mm-hmm.
Because I think the premium might be the insurance or the hedge in order to compensate for that.
You mentioned that right now on that Savannah project, you're in the process of sourcing debt and mezz and equity. In terms of what we're seeing across the U.S., the premier question coming our way is, can you help us find equity? It seems like equity is and has been incredibly difficult to come across, common equity. And to that same extent, a lot of the LP groups that we used to underwrite deals for to help them understand whether or not they should invest in a project are now coming to us with deals saying, hey, we want to now be the GP in these deals. So I think what we're seeing out there is that more and more frequently, GPs are having a more difficult time sourcing equity. How are you guys currently? What do you think of the environment currently, and kind of how are you dealing with these ups and downs?
I think the common equity market in the U.S. has been paralyzed since 22. Mm-hmm. And like a true lockdown paralysis, not a stop and start situation. A lot of groups are still active because people are justifying their jobs. Like, okay, you can't have an acquisition guy, even if he doesn't have capital to deploy, doing anything more than constantly, calling the market and trying to find the right deal. In a lot of ways, I think they were unicorn hunting, but there were still good deals to be made. If you're buying and selling within the market and understanding, you've got conviction within residential, within workforce housing, within whatever, however, like focused you want to get to what's going on, macro, micro market, product type, anything like that. You can find a deal that's going to pencil. There's such a distance between the bid and ask of the real estate as well. That's not been easy to compensate for either. Now, to answer your question about common equity, we've been using more and more pref on our development deals. This will be the third deal that we've capitalized with a construction loan, a piece of pref, and then common behind that. In 2017, 2018, 2019, you would look at the underwriting of a value add play and see a mid to high teens IRR and a nice multiple. And a wink and a nod. Hey, by the way, yeah, it's showing a 16, 17, 18, but chances are we're going to be able to beat that. We'll accelerate the plan. We'll, maybe see a little cap rate compression instead of expansion, but we can't underwrite compression. So, buying it at a 5.5 cap, we're going to sell it at a 5.25 or a 5 cap instead of a 5.75, which is where it's underwritten. But we're going to promise you that high teens return. You want an opportunistic return above 20, you're going to be in development. But what happened was people were realizing 20, 30, 40 IRRs with a value add play because of massive rent growth, along with a value add play and cap rate compression with very low interest rates on top of it. Perfect storm for, those values to shoot up, but it wasn't really at a sustainable level. Development deals, we're showing 20 IRRs, and all of a sudden people are like, well, that's not enough for the premium to take on that risk. Fast forward to today. The reason that everybody is offering me pref and everyone went out and put together a debt fund was they said there's going to be a vacuum and a need for that. But if we're now at the point where they're going to show me lower and lower returns for a core plus multifamily asset or even a value add play, where that 16, 17, 18 IRR is now a solid 14, 15, and a core plus might be a 12 to a 14, why wouldn't I put pref on that? Okay, I'm protected, and it's what they're underwriting to anyways. So why am I paying, taking on the risk of a common partner for the same return as pref? And the debt fund guy is sitting there saying, well, where interest rates are, why would I get a core return when I can probably charge 6, 7, 8, 9% for a debt fund on a bridge loan or a mezz piece? Mezz is still, low double digits. Problem is, if everybody's only offering pref and debt, those rates are going to compress. And that's exactly what happened in our, Savannah deal. It's what happened on a few other deals that we looked at from an acquisition standpoint. Pref went from 16% to 14% to 13%. By the way, a lot of pref guys want to have the tax treatment to be considered more along REIT standards. So as you start layer on, protections as more of a mezzanine feel, that can drop down into the 11, 12 range. Those debt funds had these big spreads compared to the agencies because they were going to be easier to deal with. Well, if there's one deal in the market and 7 debt funds that have to place their capital, guess what? Those spreads came in. Their DSR tests aren't nearly as draconian. They're pushing proceeds to win the business because nobody's buying. And you still have GSEs out there that are still incredibly attractive. And so right now, the capital that has sold itself on these pref and mezz and debt strategies to stay away from common but still be exposed to real estate aren't seeing the transaction volume. They have to get back into the market as common equity. And the guys that are still in the common side are either foreign capital players that now realize it's the right time to get into the market. And they're seeing IRRs that are probably double what their home country offers. But also smaller private capital guys that might do what we did and have a co-GP situation, or leave a little bit more money in the deal. You're not looking at 98-2, 95-5, 90-10 joint ventures. Maybe it's a 70-30 or a 75-25 or a 50-50. We're doing a 51-49. I think that people had to get creative to be able to attract a type of common equity to make it worth their while. And in our case, you're not quite giving up pure GP economics, but pretty close to it.
We're seeing that as well, whether you are giving up GP economics or, as you said, like pretty close to it. A really interesting point with a lot of capital moving to the debt side and how in turn that creates competition and then makes these lenders and whether it's mezz or pref more aggressively priced. Where do you think we are in that cycle? And do you think there will inevitably be a shift back into common equity? And if so, when do you think that'll occur, and how do you think that'll come about?
I had a call with an existing partner on the LP side that said for the first time in 30 months, they just signed a term sheet for common equity.
Hmm.
It's not multi. They're heavily exposed to multi. And I did ask him, I was like, if you tell me it's a data center, I'm going to laugh at you. So luckily it's not a data center. It is industrial. But for me, what that tells me is, okay, you've got a life co that has been sitting on the sidelines for 30 months that has a great debt book and a solid book of equity investments across the spectrum, not heavily exposed to office, that is slowly starting to test the waters. And their investment committee has said, we need to get back in the game. And I think it's time for us to play on the common space. And I think that's what you need to hear to say, wow, thank God, it's about time. Now, that's not a private equity player. It's an institutional player. They've got capital stacking up with premiums that they collect, and they need to place it into something that's going to get them a return that's risk adjusted in their favor. And it's nice to see that it's coming out as common and not pressed for the first time in a long time.
Mm-hmm.
But again, they were on the sidelines for 30 months. And I'm seeing that from a lot of private equity guys that will look at all of our deals and they'll say the same thing. And it's always like an element that they'll call out on an underwriting that says, oh, you didn't get a 7 return on cost. Oh, your IRR is a 15 and I need a 16.5, or you're going in caps of 5.25 and I need 5.35. Really? That's really in the margins where you're telling me, okay, thanks, but no thanks. And you're not transacting, because if I said, oh, how many of the deals have you done this year that meet those requirements? The answer is none. Well, how many did you do last year? None. Okay, so you're not in the market. And I think a lot of private equity has basically frozen in place, not because of anything more than the reputational risk of being the first one out to place any kind of large capital into a common, equity type deal. The big players, the ones that raise multi-billion-dollar funds, the Brookfields, the Starwoods, the Blackstones, they're not buying properties. They're buying companies. They're buying portfolios. There was a portfolio premium for a long time because you wanted scale. And then all of a sudden you lost that portfolio premium. But then another thing crept in, and that's the scarcity premium, because I'm not doing $30 billion of transactions in a market. Now we're doing 6. And okay, so a good deal that shows up, you've got multiple bidders for it, but it was mostly discretionary capital. And it's guys that raised those funds 4 years ago that are still trying to deploy 21 vintage funds, that are still trying to deploy 23 vintage funds, and LPs that have stacked up and said, I can't give you any more commitments until you get this money deployed. So I think that there's the potential for, on the fund side with discretionary money, to come back into the market relatively quickly as transactions start to open up. But you still have certain fundamentals that are not being met. People don't like negative cash flow day one, negative leverage. It's tough to swallow. I think that's something that's going to take a little while to overcome as well. But there are people that are willing to sign some term sheets.
Yeah, we're seeing that as well. I mean, those are all really good points. I think earlier you had mentioned the massive spread between the bid and the ask price. Where do you think that's going? And if we do see a shrink in that spread, what do you think will be the cause of that?
The quality of the underwriting right now. And I say that because a lot of people, a lot of groups are going to be guilty of this. They're using last cycle's underwriting criteria to try to force it on the next cycle's like properties. We've seen the paradigm shift occur since 2022 to today. If you're showing me 3% rent growth and 2% expense growth on a 5-year underwriting with a Freddie 5-year floating debt with a value add component, that's not reality. It's really not. Most likely, people are going to be underwriting for longer terms with less yield in the first half of the investment, more yield in the second half. You're going to see lower leverage points. You might see the return of the bridge to perm loans in order to like really financial engineer the right type of return over a 7 or a 10-year hold instead of a 3 to 5.
Mhm.
You're going to see a lot more fixed rate debt come into play. Maybe more fixed rate debt from alternative sources where you can negotiate a more flexible prepay somewhere out in the future to be able to refinance and take advantage of the capital markets at that time, but still manage your downside risk by having a longer term available if need be. But I do think that the basic fundamentals of underwriting to residential real estate need to come into play, where you're not trying to use that pro forma to fool yourself into seeing a good deal. You're going to have to understand what it's going to take to financial engineer the right return for your investor base. But from a fundamental standpoint, OPEX is going up way more than 2% a year. Property taxes, insurance, well, insurance came down for us this year, but over the course of the last 5 years, historically, it's gone up, high single, low double digits.
Mhm.
Payroll going through the roof. So you can't tell me that you're going to save it somewhere else, because the three biggest things that are moving the needle right now are taxes, insurance, and payroll. So I could save in every other category, and it's still lost by one tax bill that comes out of nowhere, or a significant increase in my insurance rates based on the next storm, the next fire, the next flood, and the cost of payroll. Every time you look at a CPI print, where's lodging? Well, lodging means that it's more expensive for people to live. So while we might see that rent growth, eventually the manager that's managing our site is going to need a little bit more in the wage to avoid to live or afford to live anywhere near the property she manages. So no, there's a lot of things that come into play there. But for me, I think it comes down to, you've got your conviction at a macro and a micro level for multifamily. How do you really see the business plan evolving? And how do you underwrite to where it looks like an attractive investment? And I think that's when you start looking for the right aligned capital partner to execute on that. Because if you try to do a one size fit all underwriting and blast it to 250 LPs, you're going to get 250 no's. You need to be able to tailor that approach and find that aligned capital and start with good underwriting that you have conviction in, to be able to then find that handful of LPs. And I don't care if it's a foreign investor, a family office, an institutional LP, a co-GP, whatever it is, to be able to get something capitalized.
To find a programmatic partner prior to, let's say, 2018, 2019, 2020, it seemed as though developers, GPs can go out, raise capital on an individual deal level, and then just rinse and repeat. It works for the GP, and more or less the LP is happy. As it stands today, how do you envision these partnerships looking? Do you think that they'll remain on a deal by deal basis? Do you think it'll be more programmatic at a portfolio or fund level, or even at an operating company level as groups try to get more creative?
I think that if I'm raising capital in today's environment, the perfect solution is a programmatic partner or an SMA, which is basically the same, where you got a single source of equity that buys into your platform, your philosophy. You see that alignment that I was talking about. You create a buy box or a build box, and you attack. If you're going to do a blind pool fund, you would better be on fund 7 or 8 and have a deep bench of capital that you've made money for in the past, and a track record that allows you to show how you're going to be doing that rinse and repeat business model. Because going out for your first or second or even third fund is going to be very, very difficult to have people trust you when they could turn around and say, and for a company our size, you go out to the same investors that Greystar or True America or Blackstone or any of these other groups, so Waterton, go after. Why wouldn't you give the money to them? What's your unique selling point where you can see why you give it to a smaller operator? Well, maybe I don't have a track record of a bunch of losses, or all my CapEx account that was dedicated to a value add play in my previous fund went to pay for interest rate caps in because I didn't foresee interest rates spiking the way they did. So there might be a chance for people eventually to get back into the fund business, but right now that programmatic partner is key. And you date before you marry, and that's the showing up with that deal that doesn't have to be a home run. You just got to get something that attracts that capital, and you try it out. But once you've spent the time and energy and legal to negotiate those docs, you want to be able to rinse and repeat. You want to be able to do it. You want to say, hey, I need a 20 or a 25 or a $40 million check to do this deal. But ideally, we want to rinse and repeat to where we've got a relationship of $250 million up or more. And is it faster and easier than trying to raise a $250 million fund? I wouldn't say easier, but it's probably the path of least resistance.
Mm-hmm.
And in the long run, probably better aligned capital and a better overall partnership than trying to deal with a blind pool. But when you find a great deal and you found one in the last few years, and you go out to the LP world, whether it's the private equity side, the institutional side, the family office side, it's not as easy to create that programmatic situation. It's great when you've been able to return capital to that person and they're willing to put a significantly larger commitment behind you, but it's still going to start out with that one deal. And if I've got that one deal and I go and try to make a market on the common side and there's only one player, is that really a programmatic approach? Or is that just the one guy that's standing up and saying, yeah, I'll take a look at that?
No, it's a great point. And it's very difficult to find that one deal right now.
Yeah.
And it's even more difficult to find that second deal and that third deal, because to your point, people aren't transacting. Right, there are too many factors kind of at play right now. But
I think some of the larger platforms have been able to successfully sell themselves, where sometimes they're fully integrated, and they groups like to see that management company, asset management company, investment arm as one unique solid unit. And other times they like the business model of understanding the value of third party managers and investment managers and people on the capital side, and it's creating more of a symbiotic relationship to be able to make something happen. If I find the only deal in town and I find the only investment partner that's willing to do that deal, does that mean that I'm going to be able to rinse and repeat and do another one? I'd love to say yes, but harder and harder to find.
Yeah, interesting points. What are you most excited about as we finish up this first quarter 2025?
I think the piece that I'm most excited about is understanding that within the next 12 months, you're going to see more activity being forced into the market as opposed to forced out of the market through extend and pretend from the debt side, where people are going to say, we're not going to extend you any longer. You need to make a decision. There's, you're underwater on your loan, you're underwater on your equity, whatever it is, but forcing deals back into the marketplace because of a broken capital stack, because of a broken business plan, because of all the things that have occurred in the last 5 years since COVID when it comes to what's been going on in the multifamily space. But also having at the same time a tremendous sense of optimism within the actual asset class to be able to say, once those deals are forced in the marketplace, you're going to have a marketplace for people to transact. It's not where you've got a broken system and you're flushing it out by throwing a bunch of transactions into the market and seeing how low can they go before people transact. It's going to be into the market where people that are sitting on the sidelines and have those fundamentals and have that good underwriting and have a new vision for the future are able to say, that fits my box and I'm gonna transact on it, and you can actually get something done. So I think what I see right now is properties being sold on the courthouse steps. People starting to say things like REO again, and it's not a dirty word, where it's like, oh my God, we're going to get penalized by, a banking regulator. We're going to get penalized by, our debt fund investor or whatever it is, and say, no, guys, we can't give these guys any longer. And believe it or not, a lot of the guys that are struggling with a broken capital stack are still going to be out there raising capital and buying next cycle.
Mhm.
You know, the properties themselves, as long as they're paying their bills, are in relatively good shape. You just need to have a little bit of a reset and a correction occur.
And do you think
So
we're there now, or do you think something?
I think that we're in the early stages of seeing that happen. And so that's at the end of Q1 of 25, after the, the cautiously optimistic approach that everybody's taking after NMHC. I think where we are right now is that optimism means that there will be more transactions in the second half of the year going into next year. And it's not just going to be organic, time to turn the capital or time to turn the property. It's going to be forced into the market, whether it's from an LP or a lender. And there's going to be plenty of capital ready to buy it.
And how do you think one can best position themselves to take advantage of these opportunities?
Stay active in the market, keep active with the broker networks, do as much, principal to principal networking as you possibly can. Track the groups that you think are going to be in need of assistance, whether it's rescue capital, whether it's, being transactional. Probably spend as much time talking to the LPs that you were showing deals to and finding out what deals they may be struggling with. No easier way to make a best friend than helping them out. And then on the next transaction, when you bring something to them, they know who you are and what you're capable of. So I think it really comes down to keeping your hand on the pulse of the market itself. And by that, not necessarily the US macro, but really know where you want to buy and what you want to buy. A lot of people are starting to follow what we did, 4 years ago and stop looking at 70s and 80s and even early 90s products, 20-year-old products, 2005. That's a B. That's a value add play. 2020 is still an A in a lot of markets. You get much older than 2000, that's a B and a C property at best. So don't show up with a deal and say, hey, this is built in 1995. It's an A. It's like, no, it's not. It's 30 years old. It's need a lot of work. But I think that, no, I do think that I'm starting to see, what do they call it on the stock market? The green shoots of transactions starting to happen.
I would agree with that. Just based off of the influx of outreach, people have been coming to us and saying, hey, look, we just saw this deal. Can you help us underwrite? Or, hey, we want to get active in the market. Can you help us build out a template? Whereas, December of last year was probably our slowest month on record, and January was one of our most active months on record. So I think there is so much uncertainty just at a macro level. And I also think people are just tired of sitting around. People just want to get out there, even if they're kicking tires, right? They just want to be active and get a better sense of the market.
You said it early. You've got clients that may have traditionally been LPs, and now they're looking at being GPs. You've got clients that are GPs that are sitting there saying, I want LP money, but shit, maybe I have to co-GP and give something up to get a deal done. I'll raise my hand and say I'm one of those. You want to take advantage of 2025, be as agile as possible. If you have $100 million to place this year, don't put yourself in a box and say, I'm an LP. Sometimes you might have to step up. Now, if you've got a charter that says you can't be, I get it. But if you don't want to cross the streams and have debt on a deal and equity, I get it. But if you see the right opportunity to place capital in multi, you're probably going to have to be creative on how you do it. GPs might have to be able to say, hey, I'm not going to be in the driver's seat. I'll be 49% of the deal. You know what? I got money out. I got it working. And I think that it's going to be a home run. So I think that agility from a capital standpoint is going to be like the true keys to success.
I would agree with that. Do you feel that way when it comes to the industry? I know we're coming up on time. If you had any words of advice right now for developers and or sponsors looking to get back in to the market, what would you tell them right now to look out for?
Just like I said with everything else, really check your underwriting, understand your costs for both land and hard costs. Understand restrictions that are coming into place from a legislative standpoint so that you're ahead of the game, because your first resident, if you're thinking about doing it now, is showing up in 2027 or 2028. What's going on there? Are you building to a 2028 standard? Or are you building to a 2020 standard? From either a sustainability standpoint, a resident satisfaction standpoint, people started changing their floor plans based on work from home. Work from home's kind of in flux again.
Yeah.
Are you thinking that the demand is based on people who are migrating away from the cities and moving to the countryside because they have the ability to work remotely? Is that really the case anymore? No, I think that for me, this is the time that people in development are going to make a significant amount of money. Last cycle, I think if I'm in those markets that I mentioned from building too many apartments for that one renter, I'm a buyer, but I'm also a land banker, because once that inventory is absorbed, that demand generator is still there.
Mm-hmm.
So I would love to buy inventory from a developer right now in Phoenix. And now that Taiwan Semiconductor is saying, I want to put another $100 million, no, $100 billion of, chip plants within Arizona, I want to own the land that's going to support those construction workers and then eventually those permanent factory workers throughout that area, because those jobs are coming in 27, 28, 29, and 30. So just like any kind of developer, you got to have an eye on the horizon, and don't just focus on today. And if you've got the conviction to say, everybody wants to eventually live in a Nashville or an Austin or a Phoenix, you're right. Just do the research, understand where their inventory is going to slowly start to absorb out and need to be increased, where you're going to see pretty significant rent growth occur, and try to ride the wave as it starts to not crest, which is what's happened,
Mm-hmm.
fall into that trough and start working its way back up. So
Yeah,
I think that it's an exciting time to really start tying up land and looking at that, but also find an aligned capital partner that's willing to grow with it.
At least from what we're seeing is you just have to be forward thinking, right? You can't look at today in a vacuum and say, oh, this is what everyone's doing, let me hop on board. No, you have to come up with your own thesis. To your point, you have to find a capital partner that you can explain that thesis to, aligns with that thesis, and then wants to help you grow it. I agree. I think it's a really exciting time for just the industry in general, but I think there's going to be a lot of opportunity on the horizon. I think there's going to be a lot of pain for a lot of groups out there who are and have been overexposed for the past however many years. But things are going to change. Things are moving in the right direction.
In the right direction. And I think, for a developer, I don't think that it's a capital partner. I think that development is going to take multiple tranches of capital throughout the life cycle to realize your goal. The cheapest capital you can find right now is a landowner who's taken back his land or controls his land and is willing to work with you while you arrange everything to get that thing ready to go vertical. And if you can't find that, then you need to find a private capital source that's not afraid to do a little bit of land banking in case the market does shift or take a little bit longer. And then once you're at that point where you're ready to go vertical, you've got the ability to put on debt, put on pref, put on common from any number of sources, especially in the future, to be able to get to that next level. And then just decide what your exit is. Is it a continuation vehicle where you want to do some empire building? Is it a merchant build where you want to, walk away and realize a promote and go recycle it and do it again? But I do think that along the way, you're going to be touching a lot of different capital sources that have vastly different profiles throughout the life cycle of development.
Mm-hmm. And I think you said it best before. You just need to be agile. You need to be agile. You need to be flexible in today's term, but as it relates to long-term thinking, you have to take a concerted effort to tackle what it is you want to achieve, right? You can't just go and be blinded by bright and shiny object syndrome. So
exactly.
But yeah, I think it's a great time out there for anyone who's looking to get involved. We've been having some really interesting conversations with family offices and private equity firms and developers who are just very forward thinking and very strategic with how they see their footprint growing. And at the same time, we've had conversations with groups who aren't very strategic. And from our perspective, because we're talking to all folks all over the country on all different sides of the aisle. When you see some of the groups out there who are so strategic with some of the other ones who aren't, you kind of get a sense of who's going to be successful throughout this cycle, and even through the good times and the bad times, right? But I really enjoyed this conversation. Cool. Thanks, Sam. We'll talk soon.
Thanks. Sounds good. Yeah.